My name is Akshay Yadav, and I'm a student of IIM Trichy, and today I'll be talking about the non-performing assets or the NPAs in the banking system of India. So the first question that we really need to ask ourselves over here is, what exactly is an asset for a bank? Well, if we delve into the balance sheet for a bank, we'll see that the liabilities are nothing but the deposits that we make into the bank. Other than that, the borrowings and the reserves that the banks have qualify as the various liabilities for a bank. On the asset side, if we see, is nothing but the loans that the banks give out. These are the revenue-making sources for the bank. So the interest that we paid on the installments, various installments for the loans that we have taken, becomes the revenues for the bank. So these qualify as the asset for the bank. Now, the asset can be divided into two things. First would be a standard asset. A standard asset would be nothing but the loans which are paid on timely basis. You give out the loans and you're getting the money back on a timely installments. It will qualify as a standard asset. But the second one, which we are concerned over here, is a non-performing asset. Non-performing asset will be nothing but the loans which were given out, whose installments have not been received by the bank for a period of, say, 3 months or 90 days. It will qualify as a non-performing asset for the bank. The next thing is these non-performing assets can be further divided into three. The first is the substandard asset, second is the doubtful asset, and third will be loss asset. How do the banks divide these three criteria for the assets? Is nothing but the timeline of the payment which has not been received by the banks. The first substandard asset would be those loans which have not received installments for a period of from 3 months to 12 months. The second, the doubtful asset, would be those loans which have not received any installments or payments from a period of say 1 year to 3 years, and if it's more than 3 years, the banks qualify those assets as the loss assets. So these loans or the NPAs are nothing but risk for the banks. So how do the banks manage it? So what the banks do is they maintain something called as a PCR, or a provisioning coverage ratio. It's nothing but the funds which the banks keep aside to manage their risks. So that will be the part of the risk of the NPAs. So the next thing that we need to be concerned about is how do the banks recover these assets or these loans that they had given up which are not being paid. So there are three approaches to it. The first is the banks go to the civil courts and they file for their cases. But due to huge number of cases along with other cases, what the government came up with was in 1993 they created a special court called as the Debt Recovery Tribunal, which took for the hearings of these NPA related cases. But again, there are some 60,000 pending cases here. So what the government came out was, in the 2002, they came out with something called as the SURFASI Act. What happens in a SURFASI Act is nothing that once you have a NPA and a bad loan, whatever the security that you had given out, that the banks have the authority to sell these securities. Say you had given up a home or as a security for a loan, it has the authority to seize this loan and gives you a notice for 60 days. If you do not reclaim or give out the payment within the 60 days, the bank sells these securities and recovers the amount that is its value for the asset, the NPA in other ways. So that's all from me. I hope you found this video enlightening, and thank you very much for watching.